RBC Europe's head of European rates strategy, Peter Schaffrik. Peter, a very
morning,
warm
Owen.
welcome to the programme. How long do you think France is actually going to hang on to its triple A?
Well, I mean, it's a bit difficult to say because you got to look at the various rating agencies. So, I mean, the obvious one which might strike relatively soon is going to be S&P. Moody's take a bit longer, and Fitch haven't really made up their mind. I mean, the most recent announcement we had was on the rating outlook, and that might take quite a while. So it depends a bit on the rating agencies. But the story is clear that the trend is down, even for the AAAs. And France is, I'd say, amongst the AAAs in Europe, the weakest one.
And how difficult is 2012 going to be for the European AAAs this year?
I mean, 2012 is going to be we think, relatively difficult year for a number of reasons. I mean, if you just look at regular bond market indicators, everything points to another good year for cash bond markets as well, because the ECB is probably going to cut rates further, we think. They're going to inject some more liquidity. There is still a lot of tension in the system, which traditionally benefits the AAA countries. But on the other hand, we think that what's going to happen in 2012, to some degree that's happened already, but is much more transfer of their own credibility to either the banks or the weaker European sovereigns. And that, of course, is an offsetting one. And then you have the negative rating agency. All in all, we think it's going to be a very, very challenging one for the AAAs.
And what about Germany? Its two-year yields, they're within a whisker of a record low. Is that going to continue through 2012? You don't really fancy German bonds, do you?
Yes, well, I mean, in the grand scheme of things, we think Germany is caught between a rock and a hard place. Because if you look at, say, the German fundamentals, they're all good. But then again, I mean, Germany has to change. Germany has to open, say, their own credibility as well for the rest of Europe and their own banks. And that's in a good state. And in the bad state, you might as well say, okay, if the other European sovereigns facing a very, very hard time, and potentially we're talking about defaults and what have you, that can't be good for Germany either. So at the back of that, we would say that particularly the front end of Germany, it's going to be a tricky year as well. And if you look at the spreads, particularly to the swap curve at more than 100 basis points, it's going to be difficult, we think, for the Schatz yields to stay that low indeed.
And what's your biggest worry as far as Europe is concerned when you're looking at the bond markets? Is it Spain or indeed is it Italy? We've got their 10-year yield again at 6.92 this morning.
Well, actually, I would say it's neither of the two is my biggest concern or our biggest concern. It's more the financial system, because that's apparently the weakest link here. So we have seen the ECB wading in, and that should probably stabilize the financial system quite a bit. But if you look at the landscape, particularly if you look at not the biggest names out there, but probably the second or third line of banks, some names you probably haven't heard in the big news, that's where we think the shakiest ground is. And if one of those falters, then that could spell trouble.
And for how long will Britain manage to retain what appears to be, at least, a safe haven status?
Well, we think that depends to a large degree how the Bank of England reacts. So, I mean, of course, at the moment they have QE2 ongoing. We think there's a very good chance that once that rolls out, they bring in yet another round of quantitative easing, which we think then probably lasts for about roughly the first half of the year, a bit less than that. And for that time, the gilts will have a very splendid performance, relatively speaking, against Europe. Once that wears out, I think that might be a different story. So the second half of the year, we think, is going to be quite a challenging one for the gilts indeed.
And what about Greece, finally? Creditors continue to resist pressure for yet more haircuts from the IMF. It's all about the coupon, isn't it? That's why the debate is at the moment. How do you think that's going to play out over the next few months?
I mean, first of all, I got to say that I'm not really privy to the talks, sure. So I can't really say where exactly the problems are at the moment. But it seems to be it's some kind of details how the new bonds will be structured. Now, I mean, it's understandable in a way because you got the creditors on the one hand, and obviously they don't want to take a huge loss, and then you've got Greece and Europeans on the other. They want to strike a deal for Greece. I mean, the question for me really is how do they get to that proposed 100 billion, which seems very unlikely to do, and assuming that they can't with the current state of play one way or the other, what is the alternative? So one alternative is that the ECB steps in and takes part in that deal, which so far they said they won't, or they do something completely different altogether. And I think that's going to pan out very early in January.
Peter
But
Schaffrik.
one thing, if I may add, it's a very hard unilateral default from the side of the Greeks. I still think that's relatively unlikely.